There's increasing talk about a shortage of physical gold and silver, and it's not just chatter. Something significant appears to be breaking in the system, suggesting a profound loss of confidence in our financial future. What's truly concerning is that 99.9% of all gold ever mined is still above ground. So, why the shortage? It seems those who hold gold and silver are unwilling to part with their assets, while those who have none are desperate to acquire them at any price. This isn't about mere paper claims or allocated assets from large institutions like J.P. Morgan. No, this is about the demand for physical metal. In a crisis, paper won't do, and big money knows it. This quest for tangible assets is driving prices higher. The evidence is compelling. Bob Coleman, a precious metals dealer from Idaho Armored Vaults, highlighted on X that borrowing fees to short SLV shares have soared to over 9%, while the availability of shares to borrow is virtually non-existent. David Jensen further reported a surge in borrowing fees for iShares SLV Silver Trust ETF shares, jumping from 2.54% to an astonishing 8.5% in just a few days. This ETF's prospectus reveals its dual role. Not only does it offer exposure to silver prices, but it also allows authorized participants, bullion banks, to secure physical silver by tendering shares. This means physical silver is otherwise scarce in the market. This extreme market behavior points to backwardation, a rare phenomenon where the immediate delivery price of a commodity is higher than its future price. It signals that buyers want the physical asset now and lack confidence in future deliveries from the paper market. This is a stark contrast to the usual contango scenario where futures prices are higher. The signs are everywhere. UK bullion dealers like Atkinson's are posting permanent messages about dispatch delays of up to 5 working days due to high demand, a highly unusual situation. This isn't normal market behavior. So, what's causing this intense scramble for physical assets? The speaker suggests we might be on the cusp of a crisis. One theory points to artificial intelligence, specifically the massive capital expenditure in AI and data centers. Paul Kudrowski, in an interview, revealed that AI and data center spending accounted for half of the U.S. GDP growth in the second quarter of 2025. While this investment is currently propping up the economy, it's heavily financed by private credit and equity, remaining opaque and off-balance sheet outside the traditional banking system. Looking back through history, Arnaud Bertrand notes that periods where gold prices more than doubled in the reserve currency of the time, such as the Roman Empire's crisis of the 3rd century or the end of Bretton Woods, always signaled a profound loss of confidence in the monetary and political order. These episodes often resulted in a transfer of real wealth from the poorer masses to the rich elites who protected themselves with gold, igniting political upheaval. The peculiar aspect of our current situation is the relative silence surrounding this potentially pivotal financial moment in mainstream discourse. Why? Because many in the mainstream don't understand gold's historical role and rarely look beyond short-term market trends. As fiat currencies and paper markets face unprecedented challenges, the demand for physical gold and silver reflects a deeper skepticism about the current financial system. The question remains, are we heading for a systemic collapse, and is physical gold truly the ultimate safe haven?